Well, all this week we've been asking you what you think about the volatility in share prices. When will global stock markets hit bottom? That's the question we've been asking on our Business 360 blog. We've been getting a lot of responses. Now is the chance for us to put your views to an expert. Tom Hugard is Chief Markets Analyst at City Index. He's been kind enough to come in on a Friday night, no less. Thank you very much, Nick. You're a great expert on the markets. You're kind of a chartist, aren't you? You look at the big patterns in the markets. So an issue like this is really the kind of thing that you make your living from.
I do. I would classify myself as a person who looks into market psychology. And because I simply believe that everything that ever happened has happened before, and it's keep repeating over and over. So call it a chartist, call it a market timer. I call myself an expert in human psychology.
Good man. Okay, here we go. Some people have got some pretty firm opinions. Let's let you know. Shabu John says, I do sincerely believe that all the major stock markets around the world hit their bottoms on the 24th and 27th of October. Gatkin09 says, it seems to me that we are at the point of maximum pessimism, and that generally means we are near the bottom of the market. And Bob from Colorado says, I suspect the bottom will be found sometime after the US presidential election results are known. The uncertain nature of the policies of either of the candidates can only fuel turmoil in the US markets. We've had a good week, Tom. It seems persuasive. Have we hit bottom?
No, absolutely not.
Okay, so it's Bob from Colorado, right? Is the US presidential elections the turning point?
No, it's not the turning point either. We're not going to see a turning point for another year and a half. I think what you're seeing now is what we call a structural bear market. And if I can cast your mind back to 2000 to 2002, late 2002, you went through a series of small bull markets and small bear markets, and that's exactly what you're going to see now. So we've been going down now for a year. I think we're going up now for 6 months. And then we are going to go lower than we were before. A couple of weeks ago, we will see the Dow below 8,000 again. We will see the S&P below 800. But right now, if you are interested in capitalizing on the move up in the stock market, you want to be invested in the stock market with at least 20 to 25% of your portfolio, of your cash in the stock market for the next 3 to 6 months. But if you have want an idea of where we are, you study where we were in 2001 after 9/11 disaster. We rallied for 6 months, and then we slid again down for another 6 to 8 months. And I think that pattern will repeat itself, because when I look back over the last 130 years of stock market history, you've never seen anything like this, where we simply just recover and go back up to the go-go days. It doesn't work like this.
Okay, Tom, here's an interesting point. John Nicholas says, keep an eye on commodities. They may well lead any recovery. Any sense in that?
Yeah, I'm a firm believer that we're in a structural bull market in gold. I'm a big investor in gold, both in gold ETFs, gold shares, but also the physical bullion gold. And right now, I believe that you have what I call a deflationary environment, where the US dollar is much in demand. And I expect that dollar demand, because it's such a flight to safety, I believe that that's going to continue another 3 to 6 months. And I think ultimately that will drive gold lower. I believe that they will drive commodities lower. But once we come out of this deflationary period in a 6 month time, I believe that it's, pardon the pun, it's off to the races again in the commodity market. And I fully want to believe, and I fully want to be invested in gold, but also agricultural commodities, because I think that's going to be the next where the next scarcity is going to come.
Okay, let's look at some of the other issues underlying all of this. This is from Yanis in Greece. He says, we need more rate cuts, more money supplied by the Fed. Greenspan did a very lousy job. I am sorry for the Americans that they have to live through this. Bad job by Greenspan?
Why don't we just have no interest rates, and why don't we just pump the world full of cheap money, and then everyone could go back to where we were a year ago? Obviously, I'm being facetious here, because this is not the answer. And zero interest rate is not the answer. Denmark is raising interest rates. Icelandic krona, they're trying to protect their currency by raising interest rates.
From 12% to 18%, quite a rise.
In a couple of hours, I suspect. The bottom line is, have we ever witnessed this before? And was lowering interest rate the solution? Take a look at Japan. 1990, we had zero interest rate. Did that stop Japan from sliding into a recession that lasted the better part of 10 years? No, it didn't. Do you want to be invested in the equivalent of Japan for the next 10 years? No, you don't.
Okay, Tom. Uma in Liverpool, she's a great faithful of these Business 360 blogs. Uma in Liverpool, UK, she's asking an interesting question. Can the stock markets actually go to zero, even hypothetically? Or is there an artificial built into the software rock bottom beyond which they simply are not allowed to go because everyone realized that would be a bad thing? Can they go to zero?
Yeah, they could.
They could, theoretically speaking. Hypothetically, isn't it?
Well, let's take a look at 1929, what we call the greatest depression of all time, the greatest stock crash of all time. We peaked at 400, 380 in the Dow, and we went as low as 32.
All right, well, there's an answer.
That would take the Dow down to below 1,000. God, I hope that doesn't happen, but theoretically speaking, Uma, that is possible.